I mean, Amazon is the biggest retailer in the US. So there's no way they would ever put Amazon in at $3,000 a share into the Dow. Yeah, so I mean, the markets are still kind of watching every headline coming out from Russia and Ukraine, right? Friday, we saw that gap up initially, or I think it was Friday, and the markets had gapped up after supposedly Putin had said something positive about maybe negotiations. And then I think it was very interesting to see how the market, after just a little bit, I mean, very limited upside, it opened up and then right away started to sell as people said, listen, you know, this guy isn't some guy that you can trust in what he says, and there's no troop movements to signal any pullback. They're still bombing, you know, the crazy amounts there in Ukraine. So the market really sold very sharply, closed at the lows of the day, which is not unusual for a Friday when the markets are closed for 2 straight days. So people don't want to be buying into Friday when you have a war that could, I mean, you know, God forbid, could escalate and draw in more countries or NATO. I mean, there's just so many risks right now that it makes it very tough to be someone who's just accumulating.
Yeah, investors love clarity, and you know, the markets are very knee-jerky to any kind of news, and you know, that's more typical of a bear market behavior, reacting to any kind of news, because it's not just what's going on in Ukraine, it's any news that comes out. The markets are very knee-jerky to it. You don't see that so much in the bull markets.
Yeah, you're right. In fact, I vividly remember how many, I mean, you know, in the last, prior to this year, 2022, but, you know, going back to late 2020 and 2021, I mean, there would be news that would hit that you'd be like, you know, that's not good news. And then the markets would sell for like an hour and then boom, off to the races they would go. And you're right, way different market environment. The psychology of the market is 100% different.
Yeah, and technically, it's only the NASDAQ that's in bear market territory, where still correction territory for the S&P and the Dow.
Yeah, and I think it makes sense, considering that if you look at the percentages, the NASDAQ was the one that had the biggest gains during COVID especially, so it makes sense that that one would be falling the hardest. I mean, there are stocks getting, I mean, you know, I've been accumulating. You know, last week I really did take some initiative and start accumulating plays, you know, Zoom. I mean, some of these charts are just getting to the level, and listen, in bear markets, notoriously, things go lower than you would think. I mean, you know, but when you look at a chart like Zoom, and I'll throw it up here on for everyone to see, I mean, you're now getting to points where you can kind of make a case that it is at a valuation level. So for me, like, I love looking back on charts and seeing that price is trading into where it was at a prior point before all this publicity, right? So during COVID, Zoom became a household name, and you're now trading at levels that were prior. So here's your March, you know, here's 2020, right? Right there. That's when COVID hit, and this is when it obviously took off. You're now trading back to levels where it wasn't a household name, yet it is still a household name. So, you know, granted, could you overshoot this level? Yeah, of course. But ultimately, I think at these levels, it starts to make sense to nibble on some technical trading levels here on good quality names. I wouldn't go to kind of the small cap route where they still don't have the earnings behind it. But Zoom, I think, is trading around a 20, 22 PE, which again is not horrendous now. I mean, when it was at 100, that was ridiculous. But at 20 to 22, you can kind of make sense. Yeah, so I mean, notoriously, stock splits, right? I mean, I want everyone to really fully understand that nothing changes for the company, just the share price and then the amount of shares outstanding change. But, you know, it is a way to kind of artificially keep your price up. And it does give buyers of options. I mean, it makes options a little bit cheaper. So, you know, you don't have to, you know, remember, you can't buy partial options. You can buy partial shares, but I don't believe you can buy partial options. So for a lot of investors that like to play options, they're just not able to play Amazon prior to the split. So I understand it getting a little bit of the upside. You know, to me, I look at the chart and it still hasn't corrected enough to make me feel comfortable. You can see that you're now trading kind of in this range where if you connect these lows, you're just kind of dangling right around this breakdown point. And that's what you don't want to see. You don't want to see this really break lower. If it does break lower, I think you're probably headed down towards the 2000 level on the chart. But yeah, interesting news. I mean, we've seen Google announce it. Apple did one not too long ago. Obviously, Tesla was a big one. But remember, Tesla did it during the bull market, so it just got amazing price action. You're now in a different environment where I wouldn't expect the bullishness to last quite as long. And I think again, it's, you know, a lot of companies will use it to kind of generate that pop in the stock that they want to get. So I think there's the new CEO at Amazon. You know, he probably wants to keep the stock somewhat up while he's trying to make new initiatives and do things like that. So a perfect example. And again, I understand it. You know, maybe Amazon is saying, hey, listen, could we get in the Dow Jones Industrial Average, right? I mean, Amazon is the biggest retailer in the US. So there's no way they would ever put Amazon in at $3,000 a share into the Dow, because it would literally dwarf every other company in the Dow, right? And that's what Apple did, right? Apple did the split and then they were able to get in. So maybe that's the angle here too, is maybe they're thinking, all right, well, we should be in the Dow, we should be in that index, and this is one way to kind of open the door, if you will. It does, it absolutely does. And again, you know, you're right on this major trend line. Let me show you this, because this is really, I mean, this trend line we hit just maybe 2 weeks ago, right here, and you had the big reversal. This was when the invasion first took place. Now you're back into that line again, and you have to say that the more times you hit a level, the more likely you break. And again, I love the analogy of, like, you know, if you're on one side of the door and it's locked, and you need to save someone on the other side, you may run against that door as hard as you can. Probably the first, second time, maybe it doesn't break down. If you keep hitting that door with all your might, eventually it breaks down, right? Just a matter of how many times. So essentially, this trend line is a door, and you've now hit it very many times, and most recently just about 2 weeks ago. So there is real risk that Apple could now be the next one to see a big decline. And hedge fund managers and institutions are so overexposed to Apple, because it's been a darling for so long, that really that could be a major collapse play where you could see it take down the markets overall, especially with the size of that company. Yeah. And at least Google, I feel like Google, at least from a fundamental point, has a little bit more earnings growth than Apple. I mean, I've always been marveling at Apple, how it kind of is trading at this multiple that doesn't reflect kind of the future growth. I mean, everyone said, oh, the App Store and this and that, but the App Store, I mean, again, comparative to their overall business, it's not that big. They still haven't announced an Apple Car, which was thought, I mean, there's so if you just look at what they have, it's definitely not a growth company. Probably should be trading at like 15 PE, and it's definitely in the mid-20s at this point. Here's your chart of Google. And again, Google, same kind of thing. It almost Amazon-ish, right? Mm-hmm. You kind of have this area right here where it's just been trading sideways inside of this range, and you're definitely hammering on support. It hasn't broken yet, but this is a chart. I mean, this type of chart pattern is a topping chart pattern. I call it kind of like a 3-mountain top, where you have these multiple times where it tries to break out and it keeps failing. And it's kind of like a Bitcoin-ish type thing at 65, 68,000, where, you know, there's a lot of bullishness. Everyone loves the company, but then why wasn't it breaking out? And the answer is, well, there's bigger money selling into it there, right? So this 3,000 even number, there's definitely big money. And if you break this doorway down here, it's got quite a bit of downside potentially, probably again back to $2,000 or so. Yep. Yeah, and valuation-wise, that makes sense with Tesla, right? I mean, it's still trading at a pretty ridiculous PE ratio. I mean, at least you can kind of say, okay, well, Apple's in that 25 level, but Tesla, I still think, is much, much higher than that. But again, if you look at the chart of Tesla, like this stock has broken down. Yeah. Now, you're still coaxing in buyers because people are mentally prepared to buy the dip, but you broke this channel that it was in, and it again retraced perfectly to what we would call the scene of the crime right there, and now it's getting pushed back down. And I've said for a long time, and I've been bearish on Tesla based on valuation, that eventually I think it's going to $500, and then 500 will be a big test level here, and then these lows right in this area. So right here is going to be a major test for whether or not this stock can hold up. And again, this stock was trading, over $1,200 not that long ago, so that would be a major haircut.